status quo on interest rates. However, we have taken actions in a number of other directions, and the details are in the document we have handed out. I'd be happy to address any of the questions there. Many of these are intended to further the growth process, and some are intended to enhance stability of the system. In terms of guidance going forward, the guidance remains what it was when we cut rates, that further action will be in the direction that was initiated, and that it will depend on developments, in particular on developments on the fiscal front, as well as a continuation of the disinflationary process. So our further actions will be driven by the data. Let me stop there and ask Gurjit Patel if he has any question, anything to add.
No, not much. One thing that I would like to bring forth is that we are at the midst of an age of competitive depreciation and beggar thy neighbor monetary policies. As you know, the Swiss National Bank abandoned its PEG. Singapore eased its monetary policy on January 28th, and it fell to its lowest level since 2010. Central banks have intervened heavily in the bond markets, bringing yields down to historic lows. This reminds one of an African saying that when elephants fight, the grass suffers. And the economists said that the ECB and Bank of Japan are printing money and devaluing their currencies, while the US economy is growing strongly. Anyone who stands in the middle risks getting crushed. I think this forms an important backdrop of our macroeconomic management as we go forward and face these quite unusual challenges. Thank you.
Okay, question time. Yes, Lata.
Morning, Doctor. When you haven't given any guidance at all, sorry, Lata from CNBC TV 18. You haven't given any guidance at all. If you can give us some idea of how you see the CPI trajectory with the old base itself. If it is only 6% as your forecast for Jan 16th now indicates, what will be the real rate that you will be comfortable with?
I've talked about all these, so I'm not sure what new guidance you want from me. I will reiterate that we are looking for developments on both the disinflationary process. We would like to see it continue. And of course, on the fiscal front, we have a budget coming up. So those are important developments that we will pay attention to. Now, I'm not going to give you a number that I'm looking for in each of these things. These are more complicated than particular numbers. They're a whole package. We would like the forces that are in play, including the transmission of lower oil prices. Of course, oil prices went up in recent days, but our hope is that the modal estimate is these things will stay low for the coming year. That as these lower prices feed into prices more generally, that will help the disinflationary process. Also, we've had a relatively stable exchange rate so far. That will help also to some extent. And there has been, some actions on food management. Of course, this is the season when vegetable prices start picking up, and we want to see how those will play out. But there is no single item that we're waiting for, but we need more data than we had on 15th of January. And we haven't had significant data since then. So until we get more data, I think we're on pause.
No, I understand until you get data, but if you could reiterate what kind of a difference you want to see between inflation and policy rates. Do you want to see a 2% difference? Do you want to see a 1.5%?
You're looking for what we think is a reasonable level of the real rate. I've said before that we think that between 1.5% to 2% is a reasonable real rate given where we are in the business cycle. Now, of course, different people have different views. You had a panel discussion with Dr. Rangarajan where he would like to see it closer to 3. There are some people who would like to see it closer to 1. There are others who mix and match and add in various risk premia and claim that the policy rate is now way into real territory. So we have to be a little careful. What we would like is the real risk-free policy rate to be about 1.5 to 2%.